How do you play a peak in real yields?
Sure, I get this question a lot. And the most traditional way people look at it is either do you go long tech or do you go long gold? Because those two have historically had the most inverse relationship with real yields. And in my view, I think going long gold is a much better play for a peak in real yield rather than tech. And the key here is, real yield could be going down either because of a dovish Fed or because of rising recession risk, right? And for tech, if it's rising recession risk, that doesn't bode well for tech as a cyclical sector. So for us, looking at upside in gold, and you have seen in the derivatives market more demand for upside in GLD options, for example, to play that peak in real yields.
Liz Ann Saunders, who was with us 20 minutes ago, just put out on Twitter the Dallas trimmed inflation statistics, something Chairman Powell watches carefully. The first derivative of this over 1 month is stunning, 3.0, 3.1, and then an explosion in the Dallas trim from 5.2 out to a ginormous 6.9. How do you fold inflation into a conventional derivative strategy in equities?
Sure. So I think the couple of ways you can look at it. So you can play it through, bond ETFs, right? So looking at, for example, we've been recommending people look at upside plays in TLT, which is longer dated bonds. And the view here is that the Fed actually will remain aggressive in trying to curb inflation and as a result, increase recession risk. And that means actually the back end of the yield curve goes down because that's much more a function of inflation and growth. You can look at it through hybrid options, so equity options that are contingent on rates. So there are different ways that you can play it. But I would say, in my view, the market has it wrong that the Fed is going to pivot. I don't think inflation is going to come in that quickly. Powell has said that he needs clear and convincing evidence that inflation is falling back down to the 2% target. I don't think that we're going to get that anytime soon.
Mandy, how much conviction, just to sort of zoom out here, how much conviction has this rally had behind it from a derivatives perspective? How much have people closed out their bearish bets on the U.S. economy, on the U.S. stock market in particular, as the market rallied the most since November 2020?
Well, first of all, what bearish bets, right? So I would say one of the defining characteristics of this sell-off in the first half of the year is that we've seen very, very little hedging in the derivatives market, and that contributes to, the relatively lower levels of VIX, VVIX, all the measures that we track in options. And part of that is because we've seen already very significant deleveraging, de-risking in terms of underlying position. So people selling out of stocks, going into cash. Now, over the past week, we have seen some pickup of upside call buying, but certainly not significant enough. So I don't think this is a high conviction rally. If anything, I think this is much more a bear market rally.